webinar here over the lunch break, trying to shed some light and give some insight to an organization that we've seen do some great things with other AEC organizations, Tax Credit Collective. And so we wanted to highlight them and have an opportunity to kind of have them present and share with you what they're doing, why they're doing it, and who's it's impacting. So I'm going to turn this over to Josh at Tax Credit Collective and look forward to hearing more about their business.
Hey everyone, my name is Joshua Massoud. I'm managing partner of Tax Credit Collective. I'm joined here today with my partner, Lindsay Pollock. We help companies identify and capture various types of federal and state incentives that may be available to them that they may otherwise be unaware of or have not captured in the past. The purpose of this presentation today is to give you an overview of a particular credit that is of interest to the AEC space, that is the R&D tax credit. The emphasis here is going to be on how do we identify cash on hand in a time of crisis. We've seen this in other industries like oil and gas and things like that, where you have some great years and then all of a sudden something comes along like COVID and puts a spin on things. And now we have to really tighten our belts and figure out and identify ways where we can identify cash that's already in our company that we don't have to jump through hoops to find, sort of like the PPP program. So towards that end, we are going to give you an overview of the R&D tax credit by walking through that with you today. We're going to look at some case study examples, clients that we have worked with, how we worked with them, really giving you a behind the scenes view of what that looks like, both from our perspective and from the client's perspective. Finally, we're going to talk about a new case that came out at the start of the year that is of particular interest to AEC firms. And we'll walk through how that may be relevant to you and what that means. And then finally, answer any questions that you may have that Ben may bring up, some common questions that sort of come up. I always like to start this presentation with 3 facts, and it sort of sets the stage for small business versus large business in the context of the US. There are 30 million businesses registered to do business in the United States, and 99% of them are small to mid-sized businesses. It's less than $50 million in revenue, less than 100 employees. That said, there are $100 billion in government incentives issued every single year, and that's the world I live in. But 80 billion of that goes to the Fortune 500. So out of 30 million businesses, most of it goes to the top half of 1%. And then the remaining 20 billion, that goes to the top quarter of 1%. It's just a very big disparity in terms of what small business looks to achieve and what big business looks to achieve. And when it comes to this credit in particular, we know based on Treasury filings that there are about 16,000 companies that claim this credit to the tune of $15 billion on the federal level. Companies that are over $250 million in revenue, they tend to claim this credit about 91% of the time. But companies that are less than $50 million in revenue claim this credit less than 12% of the time. And that's a big divide, right? And that's just what our firm seeks to remedy, if you will. We want to arm companies that are in the small to mid-sized business space with this information so that they can claim the exact same types of incentives that big business does every single day. Towards that end, we're going to talk about the R&D tax credit, the research and development tax credit, or as it's formally known in the tax code as the credit for increasing research activities. And this credit has 2 parts to it that are going to be of interest to you that I'd like you to sort of break down and understand. First is qualification. What are the requirements for what I do in terms of that qualifying for this credit? The second is quantification. We'll go through both. What types of expenditures do I have that may qualify for this credit and yield something of monetary value? Qualification of this credit is broken into 4 components, 4 prongs of a test, if you will. And if an activity or project that one of our clients engages in meets these 4-part tests, then it will qualify for purposes of this credit. The first test is an identifier test, if you will. What are you talking about? And so if you, the taxpayer, are developing a product, process, technique, invention, formula, or design, and improving that or developing new functionality, performance, reliability, or quality, then it'll meet this first part of the test. Now, in the AEC context, well, I don't develop a product, I don't have a process, I may have some construction techniques. For purposes of this, the way it plays out in practice is the design component is the business component. So that's what we end up identifying as the first part of the qualification test. The second test is that related to that business component development, you, the taxpayer, have to have uncertainty in one of three forms. So this is an OR test. It can be either one of these three. Either capability, can we develop this design or building or bridge or whatever it may be? Can we even do this? Methodology, how are we going to do this? What process are we going to use to make sure that this is developed properly? Now, what's most common in the AEC context is do I have uncertainty as to the final or appropriate design? Did my design change from when I first spoke to the client, went through a charrette process or a programming process or a schematic design process? Did that change over time from when I first started to when I ended? Because if I did, then I have uncertainty as to its final design. The next test is the process of experimentation test. And this requires that the taxpayer, related to that uncertainty, engage in some sort of systematic evaluation of alternatives. So I have choice A or choice B. For purposes of this design, I can implement this to make this look this way, or I can change this configuration so that the design presents itself this way. And then I test which is going to be better, or go through some sort of systematic evaluation as to which is going to be better. And that meets this process of experimentation test. And finally, that process of experimentation, our fourth test, it has to be technological in nature. That means it has to rely on some sort of hard science, physics, engineering, chemistry, biology. And what they're trying to do there is carve out soft science. We're not concerned with how my client feels about this particular design. We're not concerned with purely economic considerations, though that can certainly be part of it. But is there something in that process of experimentation that relies on me leveraging some sort of technology or hard science in order to conduct that evaluation? Now, any project or any activity that you engage in a year-to-year or day-to-day basis that meets these criteria will qualify for purposes of the credit. Now, let's dig in a little bit as it applies to the AEC space. Here are some common types of activities that we've seen that have qualified for purposes of this credit. BIM analysis, CAD analysis, designing building systems, assessing shape and form, developing construction documents or schematic designs, detailing those designs. That's all going to qualify for purposes of this credit. In the engineering space, there's a lot of environmental impact studies that are conducted on sites these days. Assessing new materials, designing HVAC systems or mechanical subsystems, looking at water flow systems, how to assemble or assemble or fasten component parts in the construction process. How do I utilize space? What does my industrial layout look like? Is this sustainable? These types of activities often qualify for the credit. Now, on the construction side, we look at value engineering, design build, pre-construction analysis, looking at lead initiatives, again, BIM analysis, structure and facility design constructability. These types of things in the construction context will often qualify. But really, it goes back to that four-part test. We can look at an activity and come up with a strong argument as to how an activity or project meets this four-part test, then it will qualify. We don't need to worry about these individual things. These are just examples. It has to meet that four-part test regardless. That's great. We qualify for the credit. Now, what's in it for me? What qualifies? Well, to get to that answer from the quantification standpoint, we need to know what types of costs we can allocate to this credit. The primary source of cost is generally going to be the first two on this page. That's salaries and wages and contract research. Now, when it comes to salaries and wages, we look at Form W-2 Box 1 wages. So we can't take into account any benefits. They just want the wages that are subject to taxation is the language in the tax code. When we look at contract research, we can't take the full amount, but we can take 65% of any contractors, 1099s, or third-party firms that we leverage for a project or an activity. Additionally, and this isn't common in the AEC space, but we could have supplies and materials that are used or consumed in the process and that are not depreciable in the hands of the taxpayer claiming the credit. Finally, in the age of Amazon Web Services, we can also allocate lease or rental costs of computers if they are used in research. And again, that's going to come in the form of AWS most commonly. We also see with some larger companies, perhaps they have a number of laptops that are rented or leased on a year-to-year basis, and those costs can be allocated as well. But most of the credit is going to come from that first component and the second component, salaries and wages and contract labor. So what does this break out to? So if I have $1 million in R&D expenditures, so I allocate $1 million of costs, I'm subject to, in terms of the calculation, a 50% limitation. So I take my $500,000 remaining after that limitation, and I get 20%. And that's what we call the gross credit. Now, after I plug it into the tax return and it spits out a number, that number is going to be, in terms of cash back to the person claiming, it's going to be about $79,000 or 8 cents on the dollar. Additionally, certain states, I believe there are 39, offer some form of an R&D credit as well. You get a little bit of a bonus there depending on the state you're in. California, Texas, Florida, Minnesota, a number of states have various types of state credits. So if you have state tax liability, we can leverage the credit on the state side as well for the most part. A common question that comes up is, great, I get this credit, but how do I prove it? And we're subject to the general documentation requirements under the tax code. And all that says is that the taxpayer, that's you, must retain records in sufficiently usable form and detail to substantiate the expenditures claimed are eligible for the credit. I know that's not very specific. So what do we see in practice? Well, conceptually, we want to divide this into two types of things. One, we need to prove up the allocation of time spent on activities. So what are my people doing and how much time are they spending on those things? And then two, is what they're doing meeting the four-part test? So those are two types of documentation that we really look at. And for the former, in the AEC space, we often have project costing or employee tracking or other related types of data, and that's going to be instrumental for claiming the credit in these instances. Additionally, we may have project proposals, contracts, purchase orders that break out things and activities that are done on the project on a line item basis. That's going to be really helpful as well. Further, we're going to have emails, notes, and meeting minutes from people to people that are going to put those people at a place and time working on the project. And that's going to be really handy as well. Once we establish that, we also want to verify that the activity itself was qualified. So towards that end, going back to our process of experimentation test, we're going to be looking at testing results, calculations, designs, internal review documents. We may even look at white papers or technical conference information if you're a part of that as well. But those are the types of documents that if this credit were examined, let's say on a federal or state level by an agent, this is the type of stuff that they would want to see as part of that examination. So we want to collect and analyze that if we're taking this credit. Some bonuses. So as of 2016, clients that are under $50 million in revenue for the preceding 3 years can now claim this credit against the alternative minimum tax. It may be a foreign concept to you, but basically there's a mechanism built into the tax code that says you can only reduce your tax burden to a certain amount. And once you hit that threshold, you've got to pay a certain amount of tax per year. And that's called the AMT. And as of 2016, we can now apply these credits, we couldn't before, against that minimum tax. So you can actually almost eliminate that entire tax burden as well if you're subject to this. Further, if you're under $5 million in revenue and haven't had revenue for more than 5 years, you can claim this credit on a current year return against payroll tax as well. Those are qualified small businesses. And a couple rules on that. One, when this first came out, you could amend for this. You can't do that anymore. So you have to claim this on an original return. That means you have to work with your CPA and a firm like us to make sure that you're doing this on the front end. You can't do this retroactively for this piece. Further, you can apply up to $250,000 in credit against your payroll tax. That's that 6.2% of OASDI. And there are a couple of other rules that aren't necessarily material here, but they're listed here just for reference if you talk about this credit with your tax advisor. So let's look at it through your lens. What does the process look like for capturing this credit? What are you going to do if you work with a firm like ours to capture this credit? How is that going to unfold? So generally, we start with some sort of intake process where we have worked with the client on the front end to gather whether or not this is a good idea. And we're going to take that information and pull that into an intake process on our end so that we make sure that we understand your industry, understand the specifics of your situation, so that we can set you up for success during the process. Once we have that information, we're going to submit an information request to you. It's going to include some basic financial documents, some W-2 wage lists, employee lists, organizational charts, things of that nature to help us understand the financial situation of your company, from where expenditures are, where we can find credits. Then we're going to kick the study off. At that point, we're going to walk through what are the phases of the engagement, how are we going to break this down, what that's going to look like. And then finally, we're going to, as part of that kickoff, we're going to set up some scheduling. So we want to put ourselves, you and us, on some sort of time schedule to make sure that these things get done, to make sure that we're speaking with the right people that'll provide the types of information that'll help us for purposes of breaking your company down in terms of the R&D tax credit. We talked about phases in that last slide. What are those phases? Generally, there's some sort of development phase on the front end, right? We're speaking with you and your CPA, and we want to identify 4 key things. We want to identify, do you have a TED on staff? Not a Ted Danson or Nugent, but some sort of technical engineering, design, or development person on staff or retained on a contract basis, because that's going to indicate to us that that person is likely qualified. And if that person's likely qualified, there's probably other people that qualify, and that's going to be material to determining whether or not this is even a good idea for you. The second thing we want to establish is, can you use these tax credits? Now, what do I mean by that? You can generate lots of tax credits. There's different types of credits out there and things like that, but the question is, do you actually have tax liability to offset? Are you paying tax? And that's going to be what we call usability. And that's going to be important, because you don't want to dive off the deep end unless you are sure that this is going to be fruitful. I can generate a credit, but can I actually monetize it? Next, we want to identify, who does this benefit? The shareholders, the entity. There could be private equity people involved, venture capital involved. Who's going to get what? How is the pie split up, so to speak? And finally, we want to identify statute dates. So there's hard timelines involved here, and we have to make sure certain things are filed properly and on time. We want to identify those on the front end as well. We talked about that on a previous slide. When it came to qualified small businesses, they can't capture that payroll tax credit on an amended return. So that has to be filed on an original return. When are you planning on filing? Are you going to extend? Those types of nuances. Once that development phase is conducted, then we start the first phase of the study. And that's going to be to kick off the study, submit the information request. And our goal here is we want to make sure there's enough juice to squeeze. And what I mean by that is the credit amount going to be enough to justify going through the documentation process on your end? And we want to establish that on the front end before you go through that documentation process. Additionally, there are certain things that we call study killers. Perhaps your contracts are worded in a certain way with your clients. We'll talk about that more at the end of this presentation, that prevent you from claiming the credit for those contracts. That may be a study killer. That may be yield no credit. And so don't go through the documentation portion until you've established that. Speaking of the documentation portion, that's the second phase here. That's where we're actually conducting interviews with staff and personnel, obtaining documentation, again, that proves up qualification and quantification. And then as part of this phase, we're going to deliver two things. One, we're going to work with your tax advisor, CPA, to provide the forms and schedules necessary to claim this credit. Now, on the federal side, that's going to be the Form 6765. And on different states have different procedures. Louisiana, for example, has an application-based procedure where you're approved on the front end. Certain states just file a form like the federal side. But we're going to work with you and your tax advisor to make sure that that's done correctly. Additionally, we're going to provide a study deliverable. That's going to be the documentation that meets or exceeds the 19 questions that could be asked by an IRS or state agent if this were to ever be looked at. Coming from the legal perspective, that my attorney background, I want to be prepared as if an audit's going to occur, even though it might not and probably won't. But we need to be very sure and have that documentation on hand so that we can respond timely to any requests that may be made. Finally, this is a permanent credit. We want to work with you on a year-to-year basis to make sure that you're set up for success in claiming this credit in future years. So that may be, we should store information about the credit here. We should identify these things in your contracts here. We're going to look at some minimally intrusive ways that we can make that process easier moving forward. And finally, we provide full audit representation for any credit you claim as part of our engagement. And we're going to defend you tooth and nail during that audit and examination process. So let's take a client that we recently worked with and sort of see how this unfurled from their perspective. So we had an initial conversation with them about what they do. And for them, the trigger was working with their CPA and identifying that they were in the engineering space. They were in civil engineering, to be specific. Now, when you deal in the AEC space, one of the first things that you want to do is provide some sort of initial review of client contracts that you have with your clients. Why that's important, we'll talk about a case that illustrates why that's important here shortly. But there's certain contract language that may prevent you from claiming the credit or limit the amount of credit that you might be able to take. But the most important part about this first development phase is working with you to make sure that you understand how you might qualify if you qualify. So I'm not here to convince you that you qualify. We want to educate you about what does, and then match that with what you do and see if it fits. If it does, great, you likely qualify. And if you don't, then don't waste your time with this. In this case, the client did qualify. So they did engage us to conduct an R&D tax credit study. And as part of that, we submitted the information request. And we wanted to this is part of the art of a practitioner, we walked through that information request so that they could understand what is needed and most importantly, why. So often in sort of business engagements, we send a client, here's a list of things we need. And we don't really tell them why that stuff is important. If you understand why, you'll be more willing to provide that information. It sets us up for a more successful study process. Now, once we receive that information, we have to process it, and every business has a unique data set, especially in the AEC space. We all use different systems, Deltec, this, that, or the other. Some of those systems produce data in different ways. You may have those systems set up in different ways. And we have to convert that into usable form for purposes of our calculation models. And that does take a little bit of time on our end, but that's part of the art here. We're merging a lot of different data sources to make it usable and make it auditable for an IRS agent if they were to ever examine this. As part of that initial discussion on phase one, we also identified a subject matter expert, or SME or SME, and work through that qualification with them again. So they may have not been part of the initial conversations, and they also need to understand how and what qualifies. Oftentimes, this entails meeting with the owner in a closely held company. In this particular case, with this particular client, he had identified himself as the technical point of contact. Normally, I'm a little reticent to involve the owner if they are not involved sort of hands-on. And the reason why is, in order for a SME to be usable or have useful information, you need to have firsthand knowledge of the projects and of the people doing work on those projects. As part of that, additionally, we want them to identify what is the universe of qualified projects. So you may have lots of different projects. Some of those qualify, some of those don't. So really parsing through that is the first task of the subject matter expert. Additionally, as part of that discussion, we want to develop some sort of methodology to allocate qualified time spent by personnel and contractors on those specific projects. Finally, we want to identify documentation that we can leverage that proves up the four-part test and proves up the quantification of the credit. That leads us to the calculation portion. As part of this phase one, we set up the credit model on our end with the proper forms and inputs. Again, translating vast amounts of data from multiple different sources into usable form as it correlates to the different design phases in the AEC space. So breaking down schematic design, detailed design, design drawings, construction documentation, construction administration, warranty work, charrette for the architecture space, really breaking those spaces down in terms of that data to see how it fits and see which portions qualify. And that's the general process for how we break this down. And that's what it looks like for the client. That's what it looks like from our perspective. And that's how we're working with them to create a mutual exchange of information that's going to be useful, fruitful, and efficient mostly. Some legal updates. As of 2015, I noted this earlier, but the credit is now permanent. It wasn't always so. Every year I would wonder whether I would have a job because the R&D credit might phase out and they may not renew it. That's no longer the case. Additionally, they added that you can take this credit against alternative minimum tax if your average sales are less than $50 million per year for the preceding 3 years. And finally, they added that payroll tax offset. But the most relevant new case law to the AEC space is the Populous Holdings case that came out earlier this year. Now, Populous Holdings is an architecture firm. They claimed some credits and the IRS examined them, and the IRS denied the credits. And the way the IRS denied the credits on the initial run was they attacked the contracts. So we talked about this earlier and why that's important, and I'm going to walk through why that's important with you here. And if you're working with a provider and they're not walking through this process and why it's important, they should be. So Populous claimed these credits, IRS denied. Populous said, no, we qualify, and we're going to prove that up in court. Now, a little bit of background about the law. The tax code clearly states that qualified research must be unfunded for you to claim it. And what that means is it can't, if it's funded by contract, grant, or however, then you're performing research, but you're not really having to pay for it, is their perspective. Now, you may immediately say, well, that's every contract. Well, we have to do a certain type of analysis on that contract to determine whether it's funded or unfunded. And a contract is unfunded, which means it qualifies if the payment is contingent on successful result and the taxpayer, that's you, retains a substantial interest in the result of that research. So what does that mean? So for contractors, if they can prove that they pay things on or if they're paid on a fixed fee basis, that means you're going to perform work for $100,000. And if it takes you more time than you originally anticipated, you still only get paid $100,000, then you're at risk for that contract. And if you're at risk, then it qualifies. It's unfunded. Further, if you develop the designs and you can leverage elements of those designs on subsequent projects with other clients without having to pay some sort of fee to use that design, then you retain substantial intellectual property rights to what's developed. Now, that's how it's played out for the last 15 years, 20 years when it comes to the AEC space. But curiously, the IRS denied the credit to Populous Holdings. And some facts about this case, they claimed about $300,000 in credits for projects, for about 100 projects in 2010 and 2011. And the IRS stated that they were funded by contract, that they were, what the IRS is saying is they were paid on a time and materials basis and they couldn't use what they developed. Populous said that's not the case and we're gonna protest this. So they did. The court, and this sort of mirrors our study process, the court looked at a sample of projects. So one of the things that happens in the AEC space is you may have 1,000 projects in a given year. That's a lot of projects to analyze to see if they qualify or don't qualify. So we need to look at a sample. Neither the IRS nor you nor we want to look through every single detail for every single project. We want to narrow that down to a sample of projects and confirm what that sample looks like, and then extrapolate that sample across the body of projects. Now, in this case, the court confirmed that the entire sample of Populous projects were fixed price contracts. Going back, fixed price contracts are good, time and materials not so good for this credit. Additionally, each contract in the sample contained language that granted the client of Populous the right to approve designs and dispute invoices. So if they didn't like what Populous did, they could say no. That's important. Further, the population sample of contracts did not have anything that prohibited Populous from leveraging the research that they did for future projects. So that's important as well, because that means they have rights to what they developed. Further, the contracts didn't require any physical work product documents, nor did the contracts provide intellectual property rights to the client. And therefore, the court confirmed that Populous retained substantial rights to the use of the research for each contract. So what are the lessons we learned? And Populous won, and they took the credit and they rode off into the sunset like John Wayne. So the lessons learned that we can glean from this is that has been established law for a number of years, but the IRS still challenged it. So if you get in a bad habit during the study process, if you claim this credit on your own, or if you're working with a provider and you're just sort of brushing through this contract analysis and not really going through it on a year-to-year basis, even if nothing's changed, you have to have that information and serve it up if you're ever examined. And the IRS will challenge you even though you provided that information. So you have to be prepared to argue that. So knowing the ins and outs of contract law and knowing the ins and outs of your industry as it applies to that contract law is going to be key to winning these types of disputes. So contract analysis is going to be vital to any AEC case, and that's going to be integral for any of you watching this if you're looking at claiming this R&D tax credit. Great credit, but there are rules, you got to follow them. So now here's our contact information. If you want to reach out after you watch this webinar and walk through something, conversations are free. We're always happy to talk. And towards that end, Ben, I think you had some questions that had come up.
Yeah, Josh, how small is too small from a size of company that executes on this?
Great question. There is no too small. The question is how much tax liability you have. So if you don't have enough tax liability because you don't have enough revenue and your expenses exceed your revenue or are close to the amount of revenue that you're generating, then you're not going to have tax liability. And at that point, it's not going to be useful for you. So towards that end, we generally see AEC companies that are $1.5 million to $2 million or larger are going to be can be great fits. 5 million's better, 10 million's almost always has tax liability. But I don't want to make any assumptions. If you have tax liability and you have expenditures, then you can qualify and claim this credit.
That's good to know. What's the time investment, to run through those phases with you?
That's a great question. I'm going to go back to our phase slide here. So on the development phase, that's akin to the sales process. That could take just some conversations, right? We set up our process in these phases to make sure that you're investing the right amount of time before we move on to this next phase. So on this first phase where we're verifying the credit amount, you're going to spend about 2 hours of your time gathering documents and spending time on the phone with us or in person, hopefully post-COVID, working with us to verify that credit amount and get an idea of whether this is going to be worth your time. If it is, and let's say you have a 6-figure tax credit, $100,000, then we'll proceed to the second phase. And in that second phase, generally organizationally for a $10 million engineering firm, we probably see about 8 to 10 hours of your organization's time taxed, if you will, no pun intended, towards providing information and spending time on the phone or gathering documents and what have you. So that breaks out to about $10,000 per credit hour. But 8 to 10 hours on the second phase, 1 to 2 hours in the first phase, and a couple conversations on the development phase. Not bad for potentially 6-figure return.
That's good. What is the ballpark? If you said normally the credit is in this amount of money, like what's the range that you typically see?
So we typically see on the AEC side, we just recently handled or worked with a $20 million engineering client, and their credit per year was about $175,000 per year. And over the course of 4 years, because you can go back up to 3 years to claim this credit for open tax years, the total credits was approaching $800,000.
Wow, that's awesome. Really good. And how do you work with the CPA that they work with already?
Sure, that's a common question that we encounter. I already have a CPA. Are you going to be stepping on their toes? Not at all. We work with, it's a pyramid. We work with you and your CPA in sort of a triangle to work towards getting this credit into their hands so that it can be filed properly, hand-holding through that process and helping them understand the process as well. We encounter a lot of CPAs that aren't familiar with this credit, don't know the details or ins and outs. So we're educating them as well. That's a big part of our job. So we're not here to step on any toes. We are a hired gun, if you will, very narrow focus. We're just here to attack this one specific issue.
Okay, great. Well, hey, we really appreciate your time, and we look forward to sharing this with those that might be interested. So thanks again, and have a great rest of your day.
We appreciate you. Thank you. You have a wonderful day.